Although the oil market has always been strongly correlated with macroeconomic sentiment, the opening months of 2019 have seen an especially strong correlation. So the US-China trade war, weakening manufacturing indices globally, and downgrades from major agencies for GDP growth have all weighed on sentiment and thus oil prices. However, when we do move away from the demand side and do consider the supply side, it does seem like things are tightening up slightly. So OPEC's cuts came into force on the 1st of January. It's 1.2 million barrels per day. And Saudi Arabia, the de facto leader of the group, do seem to be over-complying on their portion of the cuts. We're also seeing outages in some OPEC members, most predominantly Venezuela. So we're having renewed sanctions from the US on PDVSA, the state Venezuelan oil company. It does seem like exports will reduce significantly there. Turning away from OPEC towards non-OPEC in the US in particular, oil prices, the fall that we saw in Q4 led to some in-basin prices reaching producer break-even levels. We do think we'll see a significant decrease in capex in 2019, and this should lead us to have lower production growth for this year compared to last year. So we estimate around 1 million barrels per day of growth, compared to around 1.4 to 1.5 million barrels per day for 2018. So this should also contribute to the tightening supply picture that we're seeing. So for 2019, our view is that the tightening supply side should allow Brent to trade into the 70s for the second half of the year, provided that the worst case economic scenario does not come about.